Hello everyone, welcome back to Financial News in Palos Heights. I'm Ron Jankowski with Channel 4 and my co-host is Paul Munico with Ameriprise Financial. Today is April 25th, 2022, and I'm going to let Paul take it from there. Give us an update. It was a real active market, I should say. I'll let you discuss that. And I have last minute information that came in from Ameriprise, and we'll talk about that after you're through.
Sounds good. Today I'm going to talk about anyone that has a home or looking to buy a home, what's going on in the market, mainly how existing home sales have recently fallen. And is it mortgage rates, is it inventory, or is it high prices? Existing home sales fell 2.7% month over month in March. Now that data is according to the National Association of Realtors. Sales were down 4.5% versus the year ago period, while the median price of homes sold did grow by 15% year over year. Now, is the sales decline due to high market prices, sharply higher mortgage borrowing costs, or a lack of inventory? All three likely play at least some influence, and the combination is clearly a heavy burden on the sector. Now, despite these challenges, we believe the lack of availability, combined with what we still see as fairly solid demand, should support market prices over the intermediate term at the least. In March, the average home was on the market for just 17 days. That's a record low, according to the same researchers. Now, the month supply of homes available for sale improved moderately in March to 2.0 months versus February's 1.7 months. But the ratio improvement was almost entirely due to March's lower sales. In March, the approximate number of existing homes for sale across the U.S. was 830,000 on a non-seasonally adjusted absolute basis. Again, that's according to the same researchers. This was a modest improvement over the record low levels of 740,000 as reported for January and February. So there's definitely some changes in the real estate market as to be expected, especially with changes in interest rates and mortgage rates. How far it all goes and what it does to the housing market as this continues is yet to be seen.
Well, with the interest rates increasing a little, mortgage rates that is, the prices of homes have to come down a little.
Seems reasonable to me. If you're approved for $500,000 at one rate and then rates go up, now you're approved for, $450,000. And that has to, you would think, bring home prices down.
Right.
I'm not a realtor, but I understand logic, and that seems logical to me.
Yeah, it just seemed that way. Well, thank you, Paul, for that update. And these are comments that were sent to us from Ameriprise, and I'll let you respond to. U.S. futures pointing to a lower open. Obviously, it's down today.
Yep. Anyone that watched the market last week, Friday, was a bit of a shocking day how much we were down. And it was kind of expected we would follow through more downside action today. And at least in the futures, that's what we're pointing towards.
European markets are trading in the red at midday. And of course, it's all part of everything you've already said.
Same thing. It's a global crisis going on out there, and we're not the only ones with markets going down.
Yeah, exactly. Asian equities mainly finished lower overnight. That's all part of the same story.
Yep.
Tech dominates a heavy week of Q1 earning reports. Any comment?
Just got a lot of earnings coming in, so the market should be reacting to earnings. Are companies making money? How are they doing? How are they forecasting their next quarter? But there's so much other, we call it noise going on out there that's affecting the market too. So we'll see how the market reacts to these earnings. But there are a lot coming out, and the market should be watching them.
And West Texas Intermediate WTI oil is trading at 97.38 a barrel, which is down. It was like $104 or
It's
maybe
nice to
even
see it
higher.
under $100 a barrel, that's for sure. But,
Yeah.
I mean, it can still go down a lot more, but it won't. I don't see how it could. We'll see, though.
And the year-to-date index returns are as follows. S&P 500 is a minus 10%, Dow Jones a minus 6%, and the NASDAQ down a minus 17%.
2 weeks ago, those numbers were not that bad when we
No.
did the show, and that just shows what a couple of weeks can do. But a couple of weeks in the other way can bring it right back. So,
Wouldn't take much positive comment from the feds, and all of a sudden everything just changes.
there's a lot of issues out there, and maybe
Yeah.
just a positive, tilt on even just one of those might be enough to
Yeah.
get the market going. Who knows? It's difficult to predict.
It is very precarious situation now. Stay with us. Thank you, Paul. Stay with us. We are going to be right back with our show called Your Money, and Paul has an interesting topic, and we'll see you in a moment. And we're back with Your Money. Thank you for staying with us. As I had mentioned, Paul has an interesting topic. Today's topic is about inflation. High inflation, what should you do about changes to your investment? Paul, I'm going to let you take it.
Yep, these are questions I get a lot, especially with what's going on now, because high inflation is definitely here. And just like you said, Ron, the question is, should you alter your investment approach because of inflation? So let's kind of dive into it. Just starting with basics. If you drive a car, chances are you're feeling the pain at the pump caused by inflationary pressures and global supply chain disruptions from Russia's invasion on Ukraine that have caused the price of gasoline, amongst other reasons, to surge in recent months. But the sticker shock goes beyond just gas stations. In 2021, the inflation rate, now this is going to be as measured by the Consumer Price Index, rose by 7%. Now that's the largest annual change in living costs since the early 1980s. So what does this mean for consumers? In basic terms, the cost of an average basket of goods rose 7% in just 1 year. And it remains to be seen how long it will take for inflation to cool down. Now, while much attention is paid to how this is impacting short-term purchases like food and clothing, it's also important to consider the toll it could take on your investments. So consider that over the 10-year period ending in the year 2020, the median annual average inflation rate was 1.7%. At that level, it would take more than 40 years for living costs to double. If, as was the case in 2021, the annual inflation rate averaged 7% per year, the cost of living would double in just over 10 years. So if you're wondering if your portfolio is built to withstand these challenges, here are some information to help you decide. So let's look at these investment considerations in the inflationary times. First, remember that the change in the inflationary environment does not necessarily mean it's prudent to dramatically alter your investments. That depends on you and your specific situation. If your portfolio is appropriately balanced with your risk tolerance and your time horizon in mind, fine-tuning your investments may be a more appropriate strategy. Let's talk about equities. In general, equities, also known as stocks, play an important role in long-term portfolios. Compared to other asset classes, stocks may experience more volatility in the short term. However, they historically generate superior returns over the long term and should be positioned to do so in your portfolio, particularly if you have a long-term horizon. Making regular investments in equities through retirement plan contributions can be an effective way to build your equity holdings in a volatile market environment. Systematic investing can enable you to buy more shares of an investment at a lower expense when markets are down and pay for fewer shares when prices are up. Let's switch the gears and talk about bonds and fixed income investment. Bond yields don't always keep pace with inflation, particularly with living costs as high as they are today. If you're concerned about this, investing in Treasury inflation protected securities, otherwise known as TIPS, is one option to consider. These are marketable securities that pay a set rate of interest, but the underlying value of the bond is adjusted on the inflation rate. Also worth considering is a fixed income investment tied to inflations are I-bonds, a form of U.S. savings bonds. You can look to invest up to $10,000 per year in these bonds. The interest rate paid is adjusted every 6 months based on the inflation rate. In the early 2022, I-bonds are paying a yield of 7.12%. However, these bonds are not completely liquid, so your money needs to be committed for at least a year with full liquidity reached in 5 years. Other investments such as options. There are other instruments that offer diversification, potentially in a high inflationary period. This includes real estate, which may see rising values and higher income streams that often tend to reflect changes in the cost of living. Real estate investment trusts are marketable securities that offer ready access to the real estate market. Precious metals is an option, such as gold, can play a role in a hedge against inflation. However, gold is a highly volatile asset class and shouldn't represent more than a small percentage of your portfolio in a well-balanced, diversified portfolio. A good time to plan. It can be beneficial to sit down with your financial advisor to more carefully look at how your portfolio and overall financial plan are situated in today's economy. Your advisor can help you to evaluate how to manage your current expenses more efficiently while still keeping your most important savings goals on track.
Very interesting, Paul. Now, anymore today, especially with what's going on, if a person is not sure about their portfolio and does not have a financial advisor, can they call you?
Absolutely. Now is the time to be calling. When the market is going up, things are going well. But times like this, when it's volatile, that's really when you need a second opinion or, a opinion if you're working without an advisor. And I'm just here as a resource, so feel free to give me a call if you've got questions. I can be reached at 708-226-3412.
All right, Paul, thank you for all of the information that you shared with us both early on and your discussion with where we're at with your topic today on your money. If you're not cautious and you make adjustments without getting some professional advice, you could be losing a lot of money, and that's what's so important, that you talk to a professional person, unless you are that professional person and you're a seasoned investor. That's a different story, I guess.
When it gets like this, human nature kicks in. And when people get their statements and they're down, a lot of people's first instinct is just sell, get me out.
Yeah.
But oftentimes that could be the wrong thing. You do need to speak with someone who's got experience with markets like this.
Especially if you have long-term investments. You don't want to fool with that and make changes, because those long-term investments probably will hold very well over the period of time going through all this volatility.
Right, and who knows, they may be paying dividends, they may be doing lots of things to help support your income.
Right.
So you got to evaluate each investment you have.
Well, thank you again, Paul. For Paul Munichel with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Paler Sites, we wish you good investment day.